Hi everyone, it's Miguel again with another video in my YouTube series 10 Common Wall Street Misconceptions. If you haven't checked out my previous videos, be sure to look for the first one, which was the market is for professionals only. My second video where I dispel the misconception that money is your biggest asset. And the third misconception that I address in my most recent video before this one was that you can always be more diversified. But the misconception that I'm going to be addressing in this video is that penny stocks are the gateway to wealth. And I would say that a lot of people have this belief basically predicated upon pop culture. In particular, what they saw in Wolf of Wall Street with the character of Jordan Belfort making 50% commissions on all of the penny stocks that he sold. People think that, oh, if I get into penny stocks, then I'm going to make a lot of money just like Jordan Belfort. Well, they couldn't be more wrong because he made the majority of his money from ungodly commission rates that really don't exist in today's Wall Street culture. You're really never going to see a 50% commission rate for penny stocks today like you did back in his heyday. However, when you look at how the majority of people make money in penny stocks, for the few people who can claim that they've actually made money in this space, it's usually not the people who purchase the penny stocks, but it's usually the people who are selling the penny stocks or selling the recommendations for penny stocks that make the majority of money in this space. And they usually make that money based on three different revenue streams. First, they'll usually make money based off of advertising on their website. They'll get paid for all the clicks that they get, usually through Google AdSense or some other kind of advertising program, to where they don't actually have to be right with the picks that they make, but as long as they can continue to get people to come to their website and drive traffic, that's how they make their money. Secondly, they usually make money based off of charging high commission rates. It's not going to be 50% like it was back in Jordan Belfort's day, but it's still going to be a high enough of a return that if they can convince enough people to purchase penny stocks, that they can still usually make a sizable sum. And the third way that people usually make money from selling penny stocks is through pump and dump schemes. And what a pump and dump scheme is basically that you'll buy a significant amount of the stock that'll drive up the price. And then once you've driven up the price, you send out emails and basically blitz out a bunch of media that basically says, oh, hey, look at this stock that's doubled overnight. It's because their CEO said da 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 or whatever nonsense bullshit that they're going to say is the reason for the stock price going up. So then you buy it at the high, which causes it to continue to climb. But once they get you to buy it at the high, they sell everything that they bought in the first place, and they basically make all of the money that you put into it and leave you with virtually nothing. That's called a pump and dump scheme, and it's extremely common when you're talking about penny stocks. So I would say that if you really think that there's money to be made from the penny stock space, that unless you're going to be making money by advertising on a website, by making some kind of high commission by selling them, or by engaging in a pump and dump scheme yourself, which I think is kind of shady in the first place, then I really don't think that there's much room for you to really make money in this space. But I also have a few more reasons as to why penny stocks really are not the way to go. The first reason is that they're highly illiquid. There are a lot of penny stocks that can go days, weeks, and even months where their stock price is basically flat. The reason being is because nobody is buying them and nobody is selling them. That the volume for a lot of these penny stocks is maybe only in the tens or hundreds of shares being traded each day, which makes it a highly illiquid asset compared to shares of, say, Apple or Google, which might trade in the millions or tens of millions of shares each day. most penny stocks really don't have a lot of shares that are trading each day. And you want to have a stock that has a good amount of volume so that when you want to sell it and you need that money in the first place, that you know that there are going to be buyers who will actually purchase back the shares that you bought in the first place, and that you're not stuck waiting days, weeks, months to even find a buyer to sell them, or being forced to sell at a massive loss just because nobody's looking to purchase what you bought in the first place. Penny stocks generally are usually pretty easy to get into, but almost always close to impossible to get out of. Secondly, there's usually a lack of information about them. If you decided that you wanted to purchase stock in, say, like Alcoa or Procter and Gamble, you could go up and look their financial statements up. You could read news articles about them, read analyst reports. But if you wanted to purchase shares in some random penny stock that you found on an email that got sent to you from hotpennystocks.com, there's usually not going to be a lot of information about them. You probably aren't going to be able to find their financial statements, which might not even be accurate in the first place, which I'll get into later. You're not going to be able to find articles about them on Bloomberg or Market Watch, and there's really almost never any analyst reports, or at least credible ones, that are written about penny stocks. So I would avoid them because they're illiquid and there's a lack of information about them. But the third reason is that there's really no minimum standards for these companies, because the two major exchanges for penny stocks, which are OTC and the Pink Sheets, they really don't have any kind of minimum amount of the value of the company to be listed on their exchanges, which means that they might only have a few $1,000s in assets, which means that they could be really, really small companies. Like they could be run out of a dude's garage. You really have no idea as to how small they are. You can't really get much access to information about the inner workings of the business. And because they really don't have those minimum cash requirements, you have no idea if they even have the cash on hand necessary to continue to expand, if they have the access of credit to be able to borrow more money to continue to grow their business operations. And because they have such minimum, or rather no minimum standards, there's really no reason why you should be messing around with something that's so volatile when there are so many other opportunities to invest in well-established companies that are still operating at a profit. And the last reason, or the fourth reason, is that there's very little government oversight. The Sarbanes-Oxley Act that was passed in 2002 was a response to internal auditing fraud from corporations like Enron, WorldCom, and Tyco. However, basically what this legislation did is that it required all of these companies that were listed on major U.S. exchanges to be independently audited by an accounting firm each year to basically prove that their balance sheets, their income statements, their cash flow statements were actually legitimate and there wasn't any kind of internal fraud that was being committed by these corporations. However, Sarbanes-Oxley does not apply to OTC and Pink Sheets. They're not required to be independently audited by an accounting firm. So even if you do find a company that has a really booming balance sheet, or maybe they've got a high profit margin or a good free cash flow, you really have no idea whether that's actually a result of the business doing well or a result of internal fraud, because these companies don't have any kind of legally required checks to make sure that they're actually being accurate with what they're reporting. So because these stocks, in particular penny stocks, are going to be highly illiquid, there's going to be a huge lack of information about them. There's really no minimum standards and little governmental oversight about them. It's really just not the path to making money. And I'll challenge you to find a single billionaire that's made their money from penny stocks. You might find the occasional millionaire, but you're not going to find a billionaire who's made their wealth from the pink sheets or OTC stocks. Overwhelmingly, the richest people in America are going to be making their money by investing in equities like Coca-Cola, Procter & Gamble, well-established companies, as opposed to some fly-by-night run in some dude's garage operation that doubled overnight because they got some stupid email from penny stocks that'll make you a lot of money.com. So I hope this video was educational. Be sure to check out my previous videos and my other videos to come. I appreciate your time and thanks for watching.